This is Walter Cronkite. Watch for You Are There, another dramatization of one of history's great events by tuning to this channel tonight.
I'm Joe Rivas with Joe's Mortgage Minute, though today's time will be a little longer. Does anybody remember Walter Cronkite's You Were There series from school? If you were born after 1975, then probably not. Like he did, I'm taking us back 100 years to the 1920s to share about the origin of the mortgages as we know them today. Everything will be just like it was then, only you are there. When it comes to financing real estate purchases, mortgages have been around for centuries. The first loans called mortgages developed in the Middle Ages. The word itself comes from Norman law books as mort-gage, or dead pledge. Now, the word dead does not refer to any form of human death, but to the fact that medieval mortgages did not amortize. There was no repayment of principal until the end of the mortgage's term. This was meant to contrast them from the living pledges, or the vif-gage, which were amortizing and thus paid down during the life of the loan. As for the United States, while mortgages were a common form of debt, they did not become nearly as ubiquitous as they are today until the mid-20th century. In the early 1900s, the majority of Americans did not own their homes, and this included the vast majority of people in urban areas. But from the 1930s on, the history of American mortgages tracks the growth in owner-occupied housing in the United States. Let's take a look at the pre-Depression era. Much of the infrastructure of U.S. system of housing finance was reformed during the Great Depression. As such, prior to the 1930s, the American mortgage looked very different. Some mortgage lenders looked the same as they did today. Commercial banks underwrote and held many such loans. However, the other mortgage institutions active in the mortgage market looked very different. In the early 1900s, there were none of the securitization vehicles that exist today. In their place, insurance companies and savings and loan institutions, the S&Ls, were large issuers of holders of mortgage loans. The terms of a typical loan in the 1920s, for example, were also very different from those of today. In addition to being variable rate, pre-Depression mortgages tended to require a much larger down payment. Loan-to-value is usually capped around 50%. As such, the down payments were much larger. In 1920, the average value of a mortgaged home was $4,900 in the U.S., according to the census data. So the typical borrower would need a down payment of no less than $2,450. Note that another feature of mortgages of this era was that many, if not most, were non-amortizing. This meant that payments went only towards the interest, and the entire principal of the loan was due at the end of the term, which was often just 5 years. The result was that the average loan-to-value ratio for a mortgage stayed close to 50% for the life of the loan, perhaps declining slowly if property values were rising. The result was that the interest rates could vary considerably across regions. Mortgage loan rates were generally lower in the urban Northeast and Midwest and higher in the South and West. The average mortgage rate in New Hampshire, for example, was 5.1 in 1920 and was 8.4 in Montana. During the Depression, the strange peculiarities of this system quickly gave way to the mortgage market recognizable to Americans today. So what about the New Deal? The tight terms of those early mortgages were put to the test during the Great Depression, which was so severe it caused American home values to fall by 50% from their peak. As home prices fell, the size of the mortgage debts grew relative to home values. Loan-to-value ratios rose, exposing banks to losses in the event of foreclosures and prompting some borrowers to walk away from their mortgages. The reforms that followed the crisis included the creation of the Federal Housing Administration, the Federal National Mortgage Association, and the Homeowners Loan Corporation. Only the first two of these institutions, the FHA and Fannie Mae, still exist today. But the whole also played its own role in the creation of today's mortgage loans. Thank you for taking a look with me at the history of the mortgage industry. Everything was the same just as it was then, except...
You Are There, another dramatization of one of history's great events.
I'm Joe Rivas with Joe's Mortgage Minute. I'll catch you next time.